Most people watching this video right now are about to make the most expensive mistake of their investing lives. Not because they're buying the wrong stock, not because they're ignoring crypto or missing the next AI darling. It's because they don't even know the game has changed. Right now, in the middle of 2026, there is a structural breakpoint forming in the global energy layer. And the people who see it clearly, who position themselves before the institutional floodgates open, those people are going to look like absolute geniuses in 36 months. The people who don't, they're going to be sitting there asking, how did I miss that? I don't want you to be one of those people. That's why we're here today. My name's Dr. Ben, and at WealthForge, we don't follow the market, we design the moat. In a world of followers, we are the architects of our own freedom. Today, I'm going to hand you the blueprint, not a prediction, not a hot take, a structural blueprint built on supply chains, capital flows, geopolitical fault lines, and the raw physics of energy demand. By the time this video ends, you will understand why uranium and small modular reactors are not just an energy play. They are the greatest liquidity opportunity of our generation. And we are going to build this case layer by layer so that you don't just believe it, you understand it at a level most portfolio managers don't. Let's go. The convergence when AI met its physical ceiling. Here's something the mainstream financial press still hasn't fully grasped. The AI revolution, the one that has commanded every headline, every conference room, every venture capital dollar since 2023, has hit a wall. Not a software wall, not a regulatory wall, a physical wall. The data centers powering these models, the GPUs, the inference clusters, the next-generation training rigs, they consume electricity at a rate that is breaking the existing grid. We're not talking about a 10% uptick in demand. We are talking about data center electricity consumption projections that have doubled, then tripled, then been revised upward again inside of 24 months. The United States grid, the most developed energy infrastructure on the planet, cannot keep up, and neither can Europe, and neither can Southeast Asia. The grid was not designed for this, full stop. Now here's where it gets interesting for us as architects. When you hit a physical ceiling, the investment thesis shifts. The money stops chasing software multiples and starts chasing what I call the energy layer, the foundational infrastructure that everything else runs on top of. Think about it this way. In the early days of the internet, people got rich betting on the browser, but the people who got generationally rich, they bet on the undersea cables, they bet on the server farms, they bet on the physical layer that made the whole thing possible. We are at that exact inflection point again, except this time the physical layer is reliable, 24/7, carbon-free baseload power. And there is only one energy source on Earth that checks every single one of those boxes simultaneously. Nuclear. Not solar. Solar is intermittent. The sun doesn't always shine. Not wind. Wind is variable. It doesn't always blow. Not natural gas. Gas is 24/7, yes, but it is not carbon-free. And the ESG pressure on institutional capital makes it increasingly unfinanceable at scale. Nuclear is the only answer to the question big tech is screaming into the void right now. How do we power the future? And before you invest a single dollar in this space, you need to understand why the fuel at the center of this ecosystem, uranium, is sitting in one of the most structurally distorted markets in modern financial history. The fragility no one is pricing in. Let me show you something that should genuinely concern you about the stability of this transition. The global uranium supply chain is broken, not cracked, not under pressure, broken. Here's the reality. The world's nuclear reactors consume somewhere in the range of 180 to 200 million pounds of uranium per year. Global mine production? Still lagging well below that number in 2026. The gap is being bridged by secondary supplies, stockpiles, inventory drawdowns, recycled material. But those buffers are finite, and they are eroding faster than analysts predicted even 2 years ago. Then you layer geopolitics on top of this. When Russia's invasion of Ukraine triggered the most aggressive restructuring of global commodity flows in a generation, it didn't just affect oil and gas, it bifurcated the nuclear fuel market. Eastern Bloc nations, Kazakhstan, Russia, Uzbekistan, supply the majority of the world's enriched uranium and conversion services. Western utilities, under intense political pressure, are now being forced to build entirely parallel supply chains from scratch. This doesn't happen overnight. You cannot simply build a new uranium mine in 18 months. You can't fast-track a conversion facility in 2 years. These are decade-long capital expenditure decisions, and the West is only now beginning to seriously fund them. What this means, what the spot market has not yet fully reflected, is that long-term utility contracts being signed right now are pricing uranium at levels significantly above what the spot market shows. Utilities are paying for certainty of supply. They cannot risk their reactor going dark because their fuel supply got cut off by a geopolitical event on the other side of the planet. That gap between the spot price and the contract price is where the structural opportunity lives. The market is still sleeping on this. The institutional money knows, but they haven't fully deployed yet. And that window, the window between when the smart money knows and when the smart money has fully moved, is exactly the window we are standing in right now. The SMR revolution, from mega project to plug and play. Now, this is the part where everything clicks together, because the uranium story alone is compelling, but when you add SMRs to the equation, you are not just looking at a commodity trade, you are looking at a complete restructuring of how the world produces and owns energy. For decades, nuclear power meant one thing, an enormous, multi-decade construction project costing tens of billions of dollars, built by a government or a national utility, operated as a public service. Massively powerful, massively slow, massively expensive. SMRs destroy that model entirely. SMRs are factory-built. They're standardized, modular, and designed to be assembled on-site like industrial building blocks. A single SMR unit generates somewhere between 50 and 300 megawatts of electricity, small enough to be purpose-built for a specific campus or industrial complex, but powerful enough to run it indefinitely, off-grid with zero carbon output. And in 2026, the regulatory landscape just had its most significant breakthrough since the Nuclear Regulatory Commission was established. Multiple jurisdictions in the United States, the UK, and Canada have moved to fast-track SMR licensing frameworks. We are talking about approval timelines that have been cut from 15 years to as few as 4 to 6 years. That is not incremental progress.
That is a generational step change in what's possible. Now ask yourself this question. If you are the chief infrastructure officer at a major hyperscaler, one of the 4 or 5 companies building the world's most powerful AI clusters, and someone tells you you can own your own off-grid nuclear reactor, it powers your entire campus forever with no fuel price volatility and no grid dependency, what is your answer? You say yes, every single time. And several of them already have. The signed agreements, the letters of intent, the early-stage SMR deployment partnerships with big tech, they are already in motion. This is not speculative. This is scheduled. When a corporation owns its own perpetual power source, something extraordinary happens. That power source becomes a moat. Not a metaphorical moat, a literal, economic, competitive moat that competitors cannot replicate without a multi-year, multi-billion-dollar commitment. This is the architectural shift we saw coming. This is why at WealthForge, we don't wait for the crowd to arrive. We design the moat before the crowd even knows the city is being built. The liquidity vortex, where the trillions are moving. Let me give you the capital flows picture, because this is where most retail investors completely miss the scale of what's happening. The uranium mining sector, the entire publicly traded global uranium mining industry, has a combined market capitalization in the range of $50 to $60 billion. That is the entire sector. Now, contrast that with this: the sovereign wealth funds, pension allocations, infrastructure-focused private equity firms, and energy transition mandates that are currently circling the hard asset energy space collectively represent trillions in deployable capital. You are looking at an asset class with a market cap the size of a mid-tier tech company being targeted by capital flows that make it look like a rounding error. When that capital moves, and it will move because the mandate to own clean, reliable baseload is now written into the investment policy statements of every major institutional allocator, the price discovery in uranium equities will be violent and fast. This is the mechanical reality. The uranium sector cannot absorb a trillion-dollar rotation gradually. There's simply not enough liquidity at current prices to absorb it smoothly. What happens when enormous capital tries to enter a small market? Prices re-rate rapidly. We saw this in 2007. The early investors in that cycle made 10x, 20x returns on quality uranium names before the cycle exhausted itself. The difference in 2026, the fundamental driver, AI power demand, is not a speculative story. It is a real, measurable, infrastructure-level reality. This is not a narrative. This is physics meeting capital allocation, and the math only runs one direction. And uranium, in this context, is functioning as something profound. It is a synthetic exposure to the entire AI and robotics ecosystem without paying the 30x, 40x, 50x earnings multiples that the intelligence layer demand. You are buying the fuel that powers the intelligence layer of the global economy at a fraction of the valuation that intelligence layer commands. That asymmetry is rare. That asymmetry is the architect's opportunity. So, here's what you do with all of this. Let's talk about the structural timeline, because investing without a timeline is just gambling with extra steps. The supply-demand imbalance in uranium does not resolve itself cleanly. The new Western mine supply and the new conversion capacity being funded today will not reach meaningful production until late 2027 at the earliest, and more realistically, 2028 to 2029. The SMR projects currently under regulatory fast track will not deliver first power until 2028 to 2031 for the leading projects. That gives us an 18 to 36-month window centered on 2026 and 2027, where the structural deficit is at its most acute, where utility contracting pressure is at its most intense, and where institutional capital is actively searching for entry points before the next wave of analyst coverage makes this trade obvious. The 3 milestones to watch over the next 18 months. Milestone 1. Contract price transparency. When major uranium producers begin reporting their forward contract books publicly, and those prices confirm the disconnect from spot, this will be the signal that triggers the next wave of institutional positioning. Milestone 2. SMR regulatory approvals. Each new approval in a major Western jurisdiction, particularly the United States, will function as a catalyst. It de-risks the SMR investment thesis in real time and triggers fresh capital allocation to the supporting fuel ecosystem. Milestone 3. Big Tech energy announcements. Every time a hyperscaler announces a new nuclear energy partnership or SMR deployment agreement, it validates the demand thesis at the highest possible authority level. These are not exploratory conversations. These are balance sheet commitments. The framework for valuation as this plays out: you are not valuing uranium equities against today's spot price. You are valuing them against the long-term contract price that utilities will be forced to pay to secure supply certainty. When the market begins to price that reality, which it will, the re-rating of quality uranium producers and royalty companies will be significant. Position before the re-rating, not during it, before. Here is what I want to leave you with. The energy layer, the physical foundation that powers artificial intelligence, robotics, advanced manufacturing, and the entire digital economy, is being contested and captured right now, in real time, by the people who saw it coming.
Most investors are still playing the software game. They're chasing the flashy multiple, the narrative stock, the AI wrapper on top of the same old business model. We are not doing that. At WealthForge, we build the blueprint before the market consensus catches up. We identify the physical moat, the hard, irreplaceable structural advantage, and we position ourselves in it, not because we're lucky, because we did the work. Nuclear energy is not a contrarian bet. It is the correct structural answer to the most important infrastructure question of the 2020s. Uranium is not a commodity trade. It is the fuel of the foundational utility of the modern economy. SMRs are not a science experiment. They are the next-generation plug-and-play infrastructure platform for the most powerful corporations on Earth. This is the nuclear moat, and the architects are already building inside it. We don't follow the market, we design the moat. In a world of followers, we are the architects of our own freedom. If this blueprint hit differently for you today, if it rearranged how you see this moment, share it with one person in your circle who needs to hear it. Because the best investment you can make right now is not in a stock, it is in clarity. I'll see you in the next blueprint.
And before you go, if you are serious about building your structural position in the energy layer, I want you to do 3 things right now. 1. Like this video. Every signal helps us get this blueprint in front of more architects who need it. 2. Subscribe and hit that notification bell. Our next breakdown covers the specific royalty and producer names within this sector that offer the most asymmetric risk-reward profiles at current prices. You do not want to miss it. 3. Drop in the comments below. Are you already positioned in this space, or is this your first time hearing this thesis? I read every single comment, and your response shapes the next blueprint we build. Stay sharp, stay positioned, and remember, the architects act while the followers are still reading the headline. Dr. Ben, out.